Hello, my name is Abraham Alalde. I am the tax manager here in the Plano office, and today we're going to be discussing Roth conversions. So the purpose of this training is to provide a foundation on Roth conversions and introduce a resource slash tool that advisors can use to quickly calculate Roth conversion amounts for clients considering converting funds in a given tax year. So what is a Roth conversion? A Roth conversion involves transferring funds from a traditional retirement account, also known as a tax-deferred account, such as a traditional IRA or 401k, into a Roth IRA. For the purposes of this training and tool usage, we are assuming that the tax-deferred retirement accounts are fully funded by deductible tax-deferred contributions. So why would a client think about a Roth conversion? So lots of reasons. Once the funds are in a Roth IRA, they grow tax-free, and withdrawals in retirement are also tax-free, provided certain conditions are met. This can lead to significant tax savings in the long run, especially if you expect your investments to grow substantially. Unlike traditional IRAs, Roth IRAs are not subject to required minimum distributions starting at age 73. This means you can leave the money in the account to grow tax-free for as long as you like, which can be advantageous for estate planning. Also, heirs can inherit Roth IRAs and take advantage of the tax-free withdrawals if they are an eligible designated beneficiary. If you expect to be in a higher tax bracket in the future, it may make sense to convert now, paying taxes at today's lower rates. This is especially relevant if you believe tax rates will rise over time, or if your personal income will increase in later years. Conventional Roth IRA contributions are subject to income thresholds set by the IRS, which can make it difficult for high-income earners to contribute directly. However, with proper planning and strategy, high-income earners can convert funds from tax-deferred accounts to a Roth IRA and take advantage of the benefits that Roth IRAs offer in the future. There are two key aspects to consider when planning for Roth conversions. The first is that converting these funds triggers a taxable event. When you convert funds from a tax-deferred account, the converted amount is treated as taxable income in that year. Taxes will be due in the year of the conversion, so careful planning is essential. Generally, one of the better times to consider Roth conversions is when markets are down, or if a client is in a year when their income is lower and they want to take advantage of a lower tax bracket rate. The second key aspect to consider is the client's tax bracket. As discussed earlier, one of the primary benefits of a Roth IRA is that withdrawals are not subject to tax, making it particularly advantageous for clients who expect to be in higher tax brackets when they start withdrawing funds. However, since taxes will be owed in the year of conversion, it's important to remember that tax brackets are progressive and careful planning around them is essential. When planning for a Roth conversion, minimizing overall tax liability is crucial. Calculating the taxpayer's marginal tax bracket is a key step, and with proper timing, a Roth conversion can be spread out over multiple years to prevent pushing the taxpayer into a higher marginal tax bracket. Now we're going to transition to the Excel tool. Before we open the tool, we want to make you aware that this tool can be used primarily in two ways. The first is to back into a Roth conversion amount. You can use the tool to calculate a Roth conversion amount based on a target tax bracket you're aiming for. The second is you can assess the impact of a predetermined Roth conversion. If you already have a specific Roth conversion amount in mind, the tool can show you where your adjusted gross income, your modified adjusted gross income, or taxable income will land. Before using the tool, you will need some information from the clients, such as their income deductions, and for the deductions, specifically if they're taking the standard deduction or itemizing, as well as their filing status. Additionally, depending on how you want to use the tool, you'll need to know whether the client wants to maximize a marginal tax bracket, or if you already have a specific Roth conversion amount in mind. Okay, so we will now transition to an overview of our Excel tool. This template is based on a template that was created by Jason Brown, and we want to extend our thanks to him. Okay, so this is our tool. High level overview. We have a little key here. Anything that's a green highlighted cell is an input cell. We have separated at the bottom wages, taxable IRA distributions, taxable pensions, and capital gains and losses, and capital gain distributions, if you want more detail there. But all of these flow to the top of the sheet for calculation purposes. So you can see where the arrows point to. Now, we also want to highlight a couple of things on the tool. First, this tool helps calculate taxable income, but does not compute tax liability. Second, we want to talk about the tax treatment of capital gains and qualified dividends. Since we're not calculating taxable liability, the tool is primarily used to get to taxable income, but there are preferential tax rates down here for capital gain rates, and those are taxed first before ordinary income. The third thing we want to talk about is Social Security benefits. So we are assuming that we are maximizing the 85% of taxable Social Security benefits. That's to be conservative. And lastly, we want to bring your attention to modified adjusted gross income. So modified adjusted gross income will affect IRMA limits 2 years after the tax year that you do the Roth conversion. So it's important to note that. We have the IRMA limits for 2024 here. And again, they're based on 2 years prior. So in this case, it's based on 2022. So if you do a Roth conversion in 2024, you're going to affect your IRMA limits in 2026. So just something to be aware of. Okay, going back to the PowerPoint. So we have a couple examples that we want to demonstrate using the tool. So this first example, as mentioned earlier, the tool can be used in 2 ways. In this example, we are going to assess the impact of a Roth conversion. We have a couple is married filing jointly. They have interest income of $10,500, dividends of $5,000, Social Security income of $60,000, capital gains of $50,000. They are taking the standard deduction, and that's the amount for 2024. And we know that they want to do a Roth conversion of $100,000. So going back to the tool, I can input these amounts. So I'll start with interest. Again, we'll enter here. Dividends of $5,000. I know that they want to do a Roth conversion of $100,000, so I can plug it in there. Social Security gets plugged in here of $60,000. And as you can see, it's taking 85% of that. And I have capital gains of $50,000. And I am taking the standard deduction. So we have the amounts here for depending on the status. So we're doing married filing jointly. It's $29,200. So I'm going to do that as a negative. And as you can see, we'll get to a taxable income of $187,300. So at that rate, at that amount, we will be at the tax bracket of 22%. So that's the first way to use the tool. The next example we have is the alternate usage of the tool, which is to back into a Roth conversion. So for this second example, we have again another married filing jointly couple. They have interest of $2,000, dividends of $10,000, wages of $60,000, capital gains of $150,000. Itemized deductions of $55,000, and we want to know how much can we convert at and max out the tax bracket at 24%. So we'll delete my amounts from the previous example. So starting at the top, interest of $2,000, dividends of $10,000. I have wages of $60,000. Capital gains of $150,000. And I have itemized deductions of $55,000. So here you can see that right now we're at a taxable income of $167,000. That puts us at the 22% bracket, but we want to go all the way to the 24% bracket. So I know that the high end of that bracket is 383,900, and right now I am at 167. So we'll take that out. And I see that I can do a Roth conversion of 216,900. So knowing that, I can plug that in here. And my taxable income now is 383,900. And that puts me at the very high end of the 24% tax bracket. That would put me here. 22% if I don't do the Roth conversion. So hopefully that is pretty straightforward and helps to understand how the tool is used. If you do have any questions or suggestions on the tool, please feel free to reach out to the tax leadership team. Thank you.